Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of March the 17th, 2025. Now, to get started this week, we're going to do things a little bit different here because once again, this is an outlook, not a recap of something that's already happened. So we want to make sure that we're prepared for trading next week. There'll be more volatility with the Fed, but let's look at the correlations before we get into the indicators. I can assess here, I've put a trend line on the dollar index. That low point is going to come in at about 103.55. This is a very 103.45, excuse me. This is a very important level for next week if this can hold. Now I've drawn the trend line, a current trend line, not a trend line over many years. I've taken my most recent low point, 2 bars to the left, 2 bars to the right that are higher than the lowest point. I then go and find the exact same condition in another area, which is back here on a very interesting date. Remember this date for the video, September the 27th, 2024. So right now we have an MA diff cross, which is warning of pending dollar strength. Now, with everything that has happened here, with all of these tariffs, what is incredibly interesting is that the S&P 500 has actually been positively correlated to the dollar index since last September. We can see when the S&P 500 started rising, which was slightly before the dollar index did on September the 12th. So once again, I'm putting a trend line here, but let me be clear. This is not a confirmed, it's only a confirmed trend line if we stay above 5504, because as you can see, we have 2 bars to the left, but only 1 bar to the right. So we need the market to close above the 5500 mark on Monday, and we will get our secondary bar to confirm this particular trend line. So if we look at these conditions, first and foremost, what I will point out with the S&P 500 is the MA diff cross is rising here also. But more specifically, the S&P 500 has not dropped this extent of 6, 7, 8%, I think around 7% in the month of March since 2000, basically 17 years since we've seen a move this big and a drop this big at that particular time. So when we look at this over the course of the last year, the S&P 500 did have somewhat of a rally here at this particular time, but we want to look at the correlation here. What did the dollar do a year ago? That's the important part. As you can see, they were both rising until about April the 16th. So very interesting the positive correlation between stocks and the dollar. So if the dollar index, technically, if the MA diff cross is correct, then we may see a rise not just in the dollar index, but also in stocks. But that would be corrective in nature unless we can get above the T-cross long on the dollar index at 105.14. We're still negative on the year. Once again, guys, we don't look at annual numbers. We look at year to date. We're not in 2024 anymore. We're in 2025. So we need to know where the current monthly opening price is, the yearly opening, and even the weekly opening price is very important. And again, right now the indicators are mixed, but that MA diff cross, you can see the strength, it's starting to rise. We look at the same thing on the equity side. So if we look at the S&P 500, this would be a corrective move back to the T-cross long at 57.77. We must get over the yearly opening price or it remains down on the year. So currently the maximum drop that we've seen here, if we use the calendar yearly opening price to the lowest recorded point here, then we can assess exactly how much has this actually dropped. That's the main thing we want to know here. And we don't want to mix it up with different points. So again, if I look at that, the amount we were up or down, 7% is, again, it's been 17 years since we've had a move this big, and then we recovered from it after the financial crisis. Now, in my respectful opinion only, these tariffs do not even come close to the volatility in 2008 with the global financial crisis, where we almost took out the monetary system as we know it, along with several insurance companies. So again, we have to keep that into perspective, that maybe the market's overreacting a little bit to these tariffs. But again, that correlation is very, very important going into next week's trading. Now, gold is extended higher yet again. We can see that we've been running this past week along our T-cross long above our current monthly opening price, and we're extending higher. Now, in my respectful opinion, we're probably getting closer to a top here in gold, at least in the short term, likely around 3,040 area approximately. But again, the neural index is pointing down. And if the dollar does rise, that should let some steam out of this gold rally. But again, to be clear, gold is still very much bullish on the year. It's having a heck of a year. When we look at gold, if we look at our Warren Buffetts of the world that refuse to buy gold because they say it has no intrinsic value, well, I beg to differ. We're up 14% on gold, and on the equity side, we're down 7%. So again, we've always got to make sure each calendar year we're using that yearly opening price to gauge where we are, and not commingle previous years unless we're using a seasonal tool. But just looking annually from 365 days back from today has very little relevance when it comes to what we're doing. Again, we need hard anchor points in our trading. So for gold, if we're going to retrace this week, where we would look potentially to pick up additional longs, 29.47 and 29.16. The neural index is suggesting we are going to have a retracement, and those are our two main points. This is a custom predicted moving average based on the correlation to 31 other marks. Each one of the other markets, each one of these lines. So again, those are our key downside points. Now, when we look at light sweet crude oil going into last week, I had suggested that we may have a long here, and I still think we do. But the one thing that they're really not saying about the the tariffs, and they just keep plugging the word inflation. And in most cases, if oil is moving lower, so is inflation. The two charts have a lot to deal with. There's a very, very high correlation between inflation and oil prices. So again, the narrative that the media is attempting to spin here is questionable at best. So when I look at the predicted differences here, we are rising. We have a fresh crossover, and again, you can bring that up on your F7 in your software. But we've got momentum building up here. But again, we're looking at a corrective move higher. Our T-cross long, that's 68.45, but the yearly opening price at 70.92, that is our retracement point, and I think we can stabilize in and around this $70 mark, maybe between 60 and 70 for an extended period of time. As long as we can hold these lows down here, it actually doesn't look too bad. So that's 65.22. Watch these two areas very closely next week. But to be clear, the VP indicators are quite bullish on oil for next week. Now, when we look at Bitcoin, Bitcoin has spent the entire week here, guys, basically trading within the Monday bar range. And I've been working on this a lot with the VP live training room. And you can see that if you put a line on the high and the low of that Monday bar, we stayed within that range for the entire week. And what I was looking for last week was a break of the high of that Monday bar to go after the T-cross long and break above that. But I feel it's just a matter of time before that happens. 86,186, that's the level we keep our eye on for next week. The indicators from VP actually are turning bullish again. The MA diff cross to the upside. We've got a little bit of momentum on the predicted RSI, but I would like to see it. If we can break 60 on the predicted RSI and the MA diff continues to rise, we'll have another run potentially at that yearly opening price, maybe within the next week or two. So keep an eye out for that. But again, watch your Monday bar and the volatility, because it really is, you can see it almost mirrors this bar over here, this little channel we're running in. So if we break down below, there is very heavy support, guys, between 78,000 and 71,000 on Bitcoin. I can't rule out a test of that area, but there would be a long trade if we were lucky enough to get down that low. Now, looking at the VIX, once again, working on this one in the live EP room, and when we look at that, the VIX, where they were saying was so bullish, and in actual fact, when we look at it, and we come back here to this, and we use that Monday bar to basically say, okay, well, what are we looking at? And I do this each and every week, guys, because all these crazy announcements, they're all happening on Monday. Monday, all hell breaks loose. And then things smooth out Tuesday, Wednesday, and then we have a reversal on Thursday usually. So as you can see that it was a bull trap up here on the VIX, but now we're at a critical level for the VIX, the T-cross long 2122. If we can break down below that, then we should see the major indices and the dollar and Bitcoin all potentially rise together. That's the power, guys, of intermarket technical analysis. It's not about one market or one trade. It's about multiple markets and multiple trades, all affecting each other. So watch that area very closely on the VIX. But if it breaks down and we get back onto more of a risk-on environment, then there's going to be some significant opportunity. We just have to get that past that event risk of the VIX. Now, for my friends in Germany with the DAX, once again, we've had our retracement and we're getting ready to go higher, I think, again. So I know that it's very uncomfortable. The most uncomfortable trade is buying high and selling low, but it has tried to penetrate the key vantage point levels all week, guys, and it's failed, and we extended higher on Friday as the global indices regained a bit of a footing there. So we'll look to build on that next week. The T-cross long 22,562. That's the key level, but make no mistake, guys, the DAX is doing a whole lot better than the U.S. equities, and this is where the DAX finishes the day on Friday, and that positive correlation, as you can see, the DAX has managed to positively correlate itself to gold contracts. They're up exactly the same amount, guys. So while everybody's looking at gold, maybe you should be looking over here too. The European equity markets, they remain hot, and you can see that we're gaining momentum on that predicted RSI, our neural index strength. Everything looks to be a go here, but to be clear, this has not been bearish at all this calendar year. That's why it's so important to use the current yearly opening price, so we can say, okay, well, and they were very bearish on this last week. The analysts, a number of different websites, very bearish on the DAX. But I've maintained the bullish argument here that any move lower would be a buying opportunity, and as long as we remain above that critical calendar yearly opening price at 19,923. So with everything we've discussed here so far for next week, the first currency we would want to look at in the Forex market that is going to be potentially affected by what I've stated is the euro. So now we can see we have a potential top that is forming on this. So again, if you want to put a trend line on this, guys, it's going to be a little bit difficult, not too bad. Let's see if we can find one here, and we'll do it together. So there's our highest point, 2 bars to the left, 2 bars to the right, that are lower than this highest point. We then go and find the exact same thing, which is over here, potentially over here. The high there, 109.37. We're going to hit this one here. We've got 109.47, so that doesn't count. So we've got to go higher up to this one over here, right? So then we draw our trend line right across like this, and all of a sudden we know exactly. And what I'll point out here, and I'll bring this closer so everybody can see, on a 3-month basis, you can see that that trend line is now directly intersecting with the VP predicted high for Monday, which is 109.36. I've talked extensively about a Monday-Tuesday reversal, so if the euro goes screaming higher on Monday, then you should be prepared for a significant drop on Tuesday. That is a possibility. This is for educational purposes only. No recommendation is being made to buy or sell anything, but that's the way how powerful a properly drawn trend line can be. And combining the VP indicators, the predicted high for the day, the neural index has really been struggling as the euro's been rising. The neural index strength has been moving lower. We have an MA diff cross here, guys. That is pointing towards some kind of dollar strength, and that's the best I can say. So we would also potentially look at US Swiss franc as an opportunity. We can see that we've got 3 days in a row last week, and again, if you take something as simplistic as what I'm going to show you, you will be able to gauge the market quite effectively. So we go back to Monday and we can see that we had a push up on Monday, and then I'll use my Monday bar with all the volatility, and then you can see it just creeping up and creeping up and creeping up. So I believe we can hit the T-cross long this week. That's going to come in at 89.03, and if we can break through that, then we go potentially back to the monthly opening price, back towards 90.63. The indicators in VP appear to be on board with that, but again, the volatility coming out of the U.S. administration, I have no control over that, guys. I don't know what he's going to do or say next, but either way, it looks like the dollar can recover here. And again, if we're buying dollars, this would be another place to do it, as long as we stay in a risk-on environment. The British pound has had a big push up here, but again, it too is stalling out. We've got a high now at 129.86. And a lot of this is a fear trade, guys, on the tariffs. The tariffs are horrible. This is horrible. The world is falling apart. Well, is it? I guess we will see what the headlines bring next week, is the best I can tell you. But from the VP perspective, we're saying we've got a high in here. So again, if we see a big rally on the pound on Monday, you should question that on Tuesday, because these indicators are saying it is not bullish. So again, nothing is 100%, but we've done a pretty thorough check using intermarket correlations and everything else on here today to see if we can fine-tune this with more than just indicators, but direct intermarket correlations as identified by the VP software. Now, when we look at the dollar yen is trying to recover here, guys, but once again, this is going to be a retracement higher. I am of the opinion, and it is an opinion only, in my respectful opinion only, the yen is still grossly undervalued at this level. The better part of my career, I'm trading this thing around the 112, 113 area. So I believe we have a significant more downside after we get through some potential dollar strength. If the Fed is hinting that he's going to cut, that will speed this move up to the downside. Be careful with this pair next week. The indicators are bullish here in VP, but they're lacking momentum, and we would have to clear the T-cross long and the monthly opening price before we start buying this, and that would be all the way at 150.83. And again, in my respectful opinion only, shorting into that level is the better play. Now, the Canadian dollar, once again, is trying to recover here. We've got tariffs one week. We don't have them the next, but this is, again, the importance of using accurate anchor points. If I took a rolling performance model and said the last 15 days, no, guys, we want the current monthly opening price. You can see that that is the only thing stopping this pair from going higher. Now, Canada has an unelected new PM. We'll see where this goes. They've already dropped the carbon tax. They're desperate to get back into power, and they're willing to give up the carbon tax to do it. So again, that may be a positive for Canada, or it may not. But this exchange rate it's essentially the same party, guys, and the same cabinet. And that's what's drove this currency weaken the Canadian dollar over the last 9 years. So can they turn this around? Well, I guess we will see. But because I'm domiciled in Canada, I thought I would share what's happening here so you guys can make a decision. But right now, if the tariffs don't come off, then that is not going to be good for the Canadian dollar. The indicators in VP are saying we could have some downside here. So watch your monthly opening price very closely, 144.48. That is key. Now, the Aussie and the Kiwi have had pretty good rallies here. They've remained positive on the calendar year from day one. A couple of little minor slips below the yearly opening, but a couple of good retracements back to it, and we extended higher. So for now, a slight bias to the upside here, but we've got to get above these areas. So if we draw our trend line, and I'll do it for you again, there's my most current highest point, the verified zone, and there's my next one. So I draw a trend line like this right across, and that's going to put us approximately, I'm going to say, that's going to put that trend line at or about the 63.80 area. So we've got to push through this channel, but you'll notice it's been basically running in a channel for the entire calendar year. A little bit of buying down here, a little bit of selling up here. And so I could just simply say 64.08 is the area we need to break. And on the downside, we need to stay above our yearly opening price at 61.89. So any move towards the yearly opening price, in my respectful opinion, is a buying opportunity. And I would say the exact same thing for the Kiwi. We're running in the same channel. One could argue that this is bearish. But what makes a market here, guys, is everybody gets a say. Half the world believes it's bullish, the other half believes it's bearish, and each one has excellent arguments for why they're doing what they're doing. But when we look at this right now, we can see that we have to break through this 57.72 area. We need to break free and clear of it, get above the red zone here, and then and only then will this pair start to really extend higher. Yes, I believe the Aussie and the Kiwi, both those currencies, are grossly undervalued. And you'll notice they were, for the most part, they've broken their correlation to the equity markets and they're standing on their own 2 feet. Real money has been going in to the Aussie and the Kiwi despite everything that's happening. So once again, our major event risk next week will be the FOMC, and with that, I believe it will bring opportunity. So with that said, this is the Vantage Point AI Market Outlook for the week of March the 17th, 2025.